Two friends, same $50,000, same starting point. One buys a rental property, the other buys index funds. 20 years later, they're both convinced they made the smarter move, and they're both partly wrong. Because one of them forgot to count the hours, and the other forgot to count what leverage actually does. Let's call them Dan and Ray. Same income, same city, same $50,000 saved up. Dan puts his into a rental property as a down payment, takes out a mortgage, and finds a tenant. Ray takes the same amount and puts it into a simple index fund, adding a bit more every month, and basically ignores it. Day one, it's not even close. Dan has a house, a tenant, and a story for the dinner table. Ray has a brokerage account and a confirmation email. Nobody's impressed by Ray's choice. Everybody wants to hear about Dan's. For the first few years, Dan feels like he made the obviously smarter play. Rent checks land every month. He's building equity. The property value is creeping up. Meanwhile, Ray logs into an app once in a while and sees a number that barely moves. It genuinely feels like nothing is happening on his side. But here's what almost never gets talked about. The rent check is not the profit. Before Dan actually keeps a dollar, it has to survive property taxes, insurance, maintenance, and the months where the unit sits empty between tenants. Add in a surprise repair, a water heater, a roof, a plumbing issue, and that impressive monthly cash flow shrinks fast. Most landlords find their real, after everything profit is a fraction of what looked so good on paper in year one. Ray's account, meanwhile, is quietly doing something that doesn't show up as excitement. It's compounding. Slowly at first, almost invisibly slow, and then later, much faster. That's just how growth on a growing balance works. The first few years always feel underwhelming. That's not a flaw, that's just the shape of the curve. Fast forward a decade, and something interesting happens. The two paths start looking a lot closer than either of them expected. Dan's equity has grown thanks to leverage. He only put in a fraction of the property's price, so appreciation on the whole thing works in his favor. That's real estate's biggest structural advantage. And stock investors genuinely can't replicate it without taking on debt themselves. But Dan also spent hundreds of hours managing tenants, coordinating repairs, and dealing with the occasional 10 p.m. phone call about a broken pipe. Ray spent 0 hours. His portfolio grew simply because he kept adding to it and never touched it. Push it out to 20 years, and both end up in a similar overall wealth range. But they got there in completely different ways. Don worked for his, Ray waited for his. Don took on debt, concentrated risk in one property, one location, and dealt with real stress along the way. Ray dealt with market volatility, including real downturns that can shake even a patient investor, but never had to fix a toilet at midnight. And to be fair, index investing has real downsides too. There's no monthly income you can spend. Market crashes are genuinely uncomfortable to sit through, and there's no leverage multiplying your gains. Real estate has real advantages, leverage, certain tax benefits, and the ability to actively add value. The trap isn't choosing real estate or choosing stocks. The trap is picking one because of a headline or something someone said at a barbecue, without ever running the real numbers, including all the costs and all the hours for your own situation. So before you decide which path is right for you, ask one honest question. Did you actually account for everything? The fees, the time, the risk, or just the exciting part? If this helped you see the full picture, hit subscribe and let me know in the comments, Team Rental or Team Index Fund.